Yeah, everybody that's here and everybody that's going to be seeing this in the record are the action takers, okay? So I want to thank you guys for being here. Being educated with debt financing is very crucial to the multifamily space, okay? I can't tell you guys how important it is. During the last few months, we've had several people that has called us at the time when they needed financing. They've gone through their they've run their numbers, they've submitted their LOIs, and then they came to us, and then the deal fell through because they wasn't updated enough on the debt financing side. And you guys are here to educate yourself, and that's really good. And we only do this every 2 weeks, guys. And if you guys can get more people to join on these calls so they can get educated with the financing, because it is so, I mean, you guys know it is so up in the air right now on where the interest rates are. And we are the professionals here in this group to educate you guys, and you can call us anytime. Our numbers will be there. But with that, I'm going to, if you want to, you have the next slide up. Okay, yeah. So we're going to do, I'm going to introduce Jerry here. He's going to talk about the State of the Union, which is the current debt market. Then he's going to jump into the main topic, which is predictions for 2023 and the current debt market. And then we're going to have an open Q&A section where you guys can ask all the questions you want. And then we have a guy on here, Robert. I think he's on here, Robert Dudd, that he's going to, I think he has a deal, and him and Jerry will be talking about that, and you guys will get to see that live. And also, I want to thank the Freedom Chasers. I'm part of the Freedom Chasers right now, and Marcel's on here. He's so great. He's helped us so much. But I'm gonna give it to Jerry so he can tell you a little bit more about this new ecosystem we've got going on here, this community you guys can jump on, and we'll help. I'll let Jerry take it away. Go
All
ahead,
right, yeah.
Jerry.
Thank you. Welcome everybody. It's good to have everybody on here. And like she was saying, we get people calling us all the time. I actually had a guy just a couple days ago that called and asking crazy questions. Just he didn't have a clue really. And I mean, he had all the enthusiasm, all the excitement that you need. I could hear it in his voice. I could tell he was excited. But he didn't have the education, and he didn't know what was going on. He didn't know anything about what he needed, what he could get, what was available or anything. And as I'm talking to him, I invite him to the call, and he kind of blew it off. I invited him to this call here, to learn a little bit more about the financing end of things and all that, so he could get his deals closed. And he just blew me off, and I've never heard from him again. But, I just want to give it to everybody that's here, for being here, being ready to learn, and just taking that step in your life to educate yourself to move on to the next level. So, but we'll go ahead and get to it. A lot of you guys that are here know who the Multifamily Freedom Chasers are. Some of you guys here don't. My wife and I, we are now Multifamily Freedom Chasers, and part of this group. It's a great group of guys. I'm real happy to be working with them and doing this stuff with them. But we've got kind of getting every day of the week filled up with Zoom calls, and just all educational guys. Everything free of charge, everything educational and uplifting. Sunday nights, we have the main call for the group. Sunday nights at 8:30. and Marcel that's here. He's on the call here as well right now. Him, Victor, and Trevor, they run a great call. We had a lady on this past Sunday that has what, $500 million in real estate, and got to tell her story to us. It's pretty cool to hear from people like that. Mondays, Peter and Eddie doing broker calls live. I know a lot of people have trouble taking that step into their out of their comfort zone and making those calls. And these guys are here and doing it with you, and doing it with you and showing you how they do it to try to help you get out of your comfort zone. Tuesdays at 8 p.m. With Eddie, we got napkin underwriting, learning how to evaluate and apartment deals and things. And then on Wednesdays, every other Wednesday for now, you have us doing this debt Zoom. And right now it's every other Wednesday. We will probably eventually go to every Wednesday, but right now we're every other Wednesday. So before we go any further, Marcel, being the guy in this community, did you have anything you wanted to say?
You guys are doing great. You guys are crushing it, and I can't wait once this room here is getting packed in the next couple of weeks. You're gonna get forced to do it every week because you'll see there will be developed the need, and what you guys are doing here is amazing. I see we have Peter in the room, who's already pumping up the chat, who's one of the community leaders as well, and just make sure there is a almost an assembly line for you guys now to take action, right? Get activated on Monday, and then you can take action throughout the week and get these deals going. You'll be assisted and everything. So super excited. Make sure you all are part of the Facebook group. Like Jerry said, everything is free, right? Everything is free because it's about elevating one another. We all want to be successful one another, high-level professionals in one group, and just get to the next level all together, step by step. So I'm excited for Jerry and Shelly to give you guys some gems here, because as you guys know, without the debt, there's no deal. The market is changing on a weekly basis right now, and these guys will be able to give you indications as to where we're today. But Jerry will also give you amazing feedback as to where he believes, with his experience, the market is going to head this year. And I tell you, there's going to be bloods in the streets, and we all need to be prepared to take advantage of that. Let's go.
Yeah, cool.
Awesome. Thank you.
Yeah, thank you, Marcel. So
hey, hang on 1 second. I dropped the link in the chat for the Multifamily Freedom Chasers Facebook group. If you guys want to go there and join that group, that would be great. Like you said, we have an assembly line going there.
Yeah. I want to encourage everybody to plug into the group and be a part. So first of all, who are we? How did we get to where we're at? What all do we do? I'll just give you a little bit of a background on us. My wife and I, Jerry and Shelly, and then two of our boys there in the background of that picture. Another one here is on the call. I believe Riley is on the call, and he's the oldest of the group. Before we get going any further, we wasn't sure we was going to have this call this week. We've got a basketball game every day this week. We've got a basketball game with our kids. Tonight, their grandpa came and picked them up and took them. Our son is playing on the varsity team at his school, and they're playing the number 5 team in the state of Kentucky tonight. And so it's a big game for them. The team they're playing's got the number 1 player in the state and all that. We would have probably canceled the Zoom and headed that way, but I'm not sure our son's going to play. He's got some bruised ribs and hasn't been practicing and feeling real well. So, but I'm looking forward to hearing how the game went after this gets done. So, but we wasn't sure if we was going to do it, but we said, well, you know, he's probably not going to play. So let's do it and keep with our schedule here. So, but like I said, I'm Jerry. It's my wife Shelly here that you guys have been hearing from. We are commercial mortgage brokers and the founders of Adventure Commercial Capital. We've been in business for 3 years. We started our business about 2 months before COVID started. So we were real estate investors, I guess 10 years prior to starting Adventure. Through that process, we saw a real need for loan brokers that could walk people through the process, care about the customers, you know, and just be honest with people and be a good service to people. We'd been taken advantage of and things as young investors, and we, you know, saw a need and said, hey, I think we could make a good business of this as well. And so here we are, and things are going good, and business is growing. So everybody, as you're on here, you can take a screenshot of this page. We probably will come back to this page at the end, but take a screenshot of it, or, you know, write it down, whatever you need to do there. I'll leave it up here for just a minute. But you know, reach out to us with any questions. If you look at a deal and you just want to know if it's a good deal, feel free to reach out. I can't, you know, I can't stress that enough. Don't, you know, as of right now, I mean, you never know what the future will hold. I mean, we could get so busy eventually to where we are just not able to take all of our calls. But as of right now, you know, no need to schedule appointments, no need for any of that. Just give us a ring, and if you're worried that you're bugging us or we won't be available, send us a text right before a call is just fine. That's my cell phone number on there. So gonna ask, who are you guys? We got just a couple minutes here. If we'll take 2 people if you want to throw your hand up, or just go ahead and start talking. And I'd like to hear who you are, what you do, and where you're from. So anybody?
I can start it off.
Go ahead, John.
All right. So my name is John Jones. I'm from Minneapolis, Minnesota. I just started doing real estate this past year, 2022, in September. And I started out with a single family, had a couple homes under contract that I was doing lease purchases with. And I went to Grant Cardone Summit, and he just completely changed my mind. And now I've been focusing on multifamily, and I'm about to meet with a guy who's got a great portfolio, but he's building a new complex on 1000 Main Street, Minneapolis. And we're going to go in and work together now. So
Awesome.
It's been up and up. Yeah.
Awesome, man. Congrats.
Thank you.
All right, Kevin, we'll get you in and we'll get Mai in, and then we'll get started. Go ahead, Kevin.
Hey, Jerry, good to see you.
Hey, good
Hello,
to see
Shelly.
you.
Yeah, so I'm Kevin out of New York. I'm a real estate attorney. I've done a bunch of single family stuff up to this point, finishing up my first new build. So excited to learn and connect. I'm also licensed in Florida as well. So good to be here,
Awesome.
man.
Yeah, good to have you. All right, go ahead, Mai. It's good to see you.
Hi, Jerry and everyone. My name is Mai. I sat next to both Kevin and Jerry at the July summit, I believe. And I also met with his beautiful wife, Shelly, there. I started January of 22 in the club. I struggled like heck for the first 4, 5, 6 months because I was really busy with my work. I'm a CPA, so very long hours. January to April, right? And then I made a few missteps too, but I continue to plow ahead. And if everything goes by as planned, I will be GP in 518 units by the end of January. That's through a lot of hard work. I found very good people to partner with, and we will be very happy to help. You know, those of you who are new and need help. I'm a CPA, so working with Excel spreadsheet come natural. So if you guys need any help, let me know.
Yep. And I'll vouch for mine, say that my is a networker, man. She is on it, and she knows a lot of people, and she really is there, and she'll help anybody that calls her. So
Thank you. I will do
Yeah.
the same as you, Cherry. Thank you.
yeah. So great. I appreciate you guys speaking out and introducing yourselves. So talk a little bit about the current debt market and where we're at as we speak. Current rates, the Fed rate, we're at 4.25 to 4.5. The SOFR, or secured overnight financing rate, we're right around the 4.33 mark. When you guys hear different lenders, and you'll hear different ones say, oh, well, we lend at, X number of points over SOFR. They'll say, oh, we're at 2.25 over SOFR. That means that they're like, at 6.5%. So just kind of let you know what those things mean, and what it is, and where you'll hear it. As far as the rates, the rates are up. I think everybody on here would know that. Rates are up, and what does that mean? What does that mean to us as real estate investors? And more or less, the main thing it means is it puts a crunch on affordability. Back in January of last year, if you could have afforded $1 million mortgage, you're probably at a $600,000 mortgage right now. And so people that were shopping aren't getting as much house for what they would have expected to. If you're buying apartment buildings, your debt service, instead of maybe $300,000 a year, you're now at $475,000 or $500,000 a year that your debt is costing. And so it's killing the values of property. Things a lot of things haven't caught up to it yet. Real estate kind of moves slower than what the Fed might, just jump in and bump these rates up and things. And the owners of these pieces of real estate, they're not just all of a sudden overnight going to say, oh, well, my property's worth $3 million less, I'm going to sell it for that way. No, I mean, most of them are going to hold out, and they're going to try to survive until they can get more money out of their property when the interest rates come down, or when rents go up, or whatever it is. So that's kind of what it means, when we're talking about the market changing, and what the rates do to the market, is it just changes affordability. It changes the debt service coverages, where, back, a year ago, you were looking at properties and funding, 70 to 80% of the deal. The lenders will still fund that much, but now instead of the debt service being a 1.2 at 80% loan to value, we're down to like maybe 60 or 65% to get to a 1.2 debt service. So that's what that's doing to the market. A few things here just since the beginning of the year, January 2nd. We've had a few changes in some of our lenders. Not so much our bigger lenders that do our Freddie and Fannie debt, but some of our bridge lenders, some of our secondary market lenders that are lending the non-bankable loans that are like 500,000 to 2 million range. Those have gotten a lot more expensive since the first of the year, and a lot of that has to do with just a lot of new people. I'll say a lot of new people are looking at these types of deals just so they can start getting some deals under their belt and things. But the last two quotes I've gotten on deals like this, I went to some of my go-to lenders for these types of deals. Two of them have backed out of the market altogether and are not lending on multifamily, from the 5 to 20 units, 500 to 2 million. They've just pulled out of the market altogether, and they're said, we're going back to the single families, 1 to 4s. We're not doing anything in this market right now.
Wow.
With that type of asset. But the quotes I was able to get, you know, they're not locking in any rates until closing. And they're saying the quotes I got have both been, we're going to be 4 points over the Fed rate at closing. So whatever the Fed rate is when we get to closing, we're going to be 4 points higher than that. And so right now that would put them at about 8.5%. So that tells you a lot about that asset class. You know, this hasn't happened with the bigger assets. And it hasn't happened like with the 1 to 4s. But in that kind of middle range, they've gotten real leery of them just because there's, you know, a lot more, it's a lot more risky for the lenders. There's a lot more foreclosures and things like that in that space. So just keep in mind when you guys are looking at deals, you know, the littler deals that, you know, you might get them for 30,000-40,000 a unit. You know, you're going to pay for it in another way, you know, maybe with interest rate or terms or whatever. So we'll got the next 2 slides or something else that you guys might want to take a picture of. This is my latest, you know, with the agency financing. This first picture here is the small balance programs. So Freddie Mac is 1.5 million minimum loan size to 7.5 million. And then the one on the bottom is Fannie Mae, 2 million to 6 million. And these are not purchase prices. So if your purchase price is 10 million, you're going to be in this arena because your loan amount is going to be 7.5 or lower. So these are loan amounts, not purchase prices. So if everybody's gotten a screenshot or a picture of that, that'll kind of help you as you're underwriting deals and things. The next one here is the conventional through the agencies, which is, you know, 6 million plus for Fannie, 7.5 million plus for Freddie. And you can see when you get to the bigger amounts, the rates are a lot better. We even have some in there, you know, when you get down to the 55% LTV and you know, 1.5 on the debt service, you can get down in the 4s with some of these deals. So the nicer assets, you know, better management you can get in place, you can afford better management, all these things, and the banks like that. So, all right. So, go ahead, Natalie.
Hi, good evening.
Hey, good
Appreciate
evening.
you for hosting us and having us tonight. Quick question. Can you repeat the range? I heard you say in the middle range um, of multifamilies that it's becoming a little more risky for the lenders. So
Yeah.
what would you say is a safe number to, like, maybe a minimum or maximum? Because you said like A class, it seems like would be, you know, are not, it's not as risky, and something that's probably smaller. So what would you say would be like a good range to stay that's not as risky for the lender?
Well, and you know, when I'm saying, you know, that those loan amounts, you know, just to let you know, you know, maybe it is that you know that the rates are higher
Mhm.
and you know those things, and so you can go into the sellers with some better, with, you know, more favorable numbers to you.
Mhm.
You know, so I mean, just, you know, and I'm saying that, you know, not to steer people away from those, but just to let
Mhm.
you know that if you're going after those types of properties, you're going to be paying a lot higher rate, and you know
Mhm.
your purchase price needs to reflect that.
Got it.
You
And
know,
would you say that would be, I'm sorry, go ahead.
like when you're looking at these higher amounts, I mean, these higher amounts can be a C-class property.
Mhm.
But you know, when you get the higher loan amounts, maybe you have 100 or more units. That's like the kind of the break point.
Mhm.
When you have 100 units, it can support a full-time manager. And it can support a full-time maintenance guy. And having those things in place, help the management of the property, help it to run smoother. It just makes it more of a stable business for the bank to invest in.
You
So
got it. And then on the lower end, so like um maybe would a 10 unit also be not as risky, or do you think it's just 100 and up?
yeah, I mean, a lot of it has to do with the asset. I mean, there's 10 units. Like if you go to certain parts of the country, you'll buy a 10 unit property for $1 million a unit,
Mm-hmm.
and you'll get good rates on that because of the amounts.
Okay.
And then, the banks also, I mean, they're looking at, more sophistication, when you're at the higher amounts as well, because you've got more capital to put in and things. And,
Mhm.
more capital doesn't always mean you're more sophisticated as
Mhm.
far as an investor, but, there's more skin in the game, less likely, to default. Maybe you've got more in the bank to help you get through rough times and things like that as well. So,
Got it. Thank you. I appreciate the response.
yeah, no problem. Hope it helped.
Jerry, if you don't mind, I'd like to kind of chime in on that a little bit.
Yeah. Hey, Peter. How's it
How are
going,
you
bud?
doing?
Good.
Good. So, I know when people get started, they tend to think small when it comes to multifamily. And my guess is the 10 unit you're looking at is not $1 million a unit. It's a low price, and that's why it's attractive to you.
Yeah.
I encourage you to show up to these meetings, come especially on Sunday night for the activation meeting, and just educate yourself. Just throw yourself into education, because I promise you, it seems totally counterintuitive, right? But it will be easier for you to raise capital for a 100-unit building than it will for a 10-unit building. You're going to have a really hard time getting anybody's attention to bring 30% of the cost of that 10-unit building. Number one. Number two, you're not buying a business at that point. You are buying a job.
Yeah.
You're going to have to manage it. You're not going to be able to pay. If you pay a manager, there won't be anything left for you. In fact, it'll cost you to own that building more than likely. So in multifamily space, you just have to think bigger. That's the bottom line. I encourage everybody on this call, if you're thinking less than 50 units, spend more time listening to more Zooms, educating yourself more. Bigger is better in multifamily. I promise you that.
Yeah. 100%. Thanks, Peter. Thanks.
That
Yeah, bigger is better. And and I can't overemphasize it enough, the way he said, be in these meetings, be in these groups. When you do find a deal and you get a signed contract and an offer accepted, if you're in these groups and people know you, you're going to find capital through this group. So there's people in this room, right now we got 61 people. I don't want to get personal. When we had our real estate club meeting, Grant Cardone said, hey, raise your hand if you've got 100,000 in the bank. Raise your hand if you've got $1 million in the bank. And I mean, there was people in there still had their hand up at 20 million, in our club meeting. And so there's people like that in this room right here. So when you find a deal, don't be afraid. You get the deal, you get the debt, and the equity will come. So there's no shortage of money, just shortage of connections to get the money sometimes. So.
Thank you. I appreciate
All right, I'm going to go ahead and move on here. The main topic, we're talking about 2023. I hear a lot of people comparing to, like the downturn or whatever we're going through right now in real estate. They compare it to 2008 because that's what a lot of people have lived through. And I read an article in a Scotsman's Guide. And so most of this information comes from this article, but it was a real parallel to kind of what's going on right now in the market. On what Jerome Powell or the Fed is trying to do. It kind of mirrors what they did, from 1979 to 1983. We had inflation running away. The Fed chair back then was Paul Volcker, and he was able to reduce the inflation rate from 14.8 in 1980 down to less than 3% by 83. And so that right there is what the Fed is trying to do again. We're at a 7 point something right now. We actually have the new CPI numbers or inflation numbers coming out tomorrow. There's a lot of people thinking that the inflation is going to go down to, into sixes when it comes up tomorrow. So hopefully that's the case. I say hopefully that's the case. I don't want to say if it's not the case that it's bad, because if you're an owner of real estate, and you don't have yourself in a squeeze, you're in good shape. So if other people are getting squeezed because of bad decisions and bad things they did, it kind of becomes your benefit as things move on. We all want to get good deals. So that's kind of what I'm looking forward to in 2023 is being able to cash in on some of these deals that I think are going to be coming. So, how did Paul do this back in the early 80s? Well, in 1979, the federal rate or the interest rate was at 11%. And by 1981, it had raised to over 22%. So in just a short period of time, they doubled the rate, which is kind of what we've had, just lower numbers. Our rates had gone just about double from January to where we're at now, January 2022 to where we're at now, we're double. So kind of mirroring what happened back then. By 1983, they had lowered the inflation rate below 3%. And I say so success with the question marks, because they were able to lower the inflation rate, but doing that, we're seeing it on our end now, where lowering the inflation rate, is leading us into a recession. And we had recessions, a couple different ones from 1980 to 1982. And then by 1983, the unemployment rate had grown to over 10%. If you've had the news on it all, we're seeing a lot of layoffs. We're seeing a lot of different things, happening in the market. We're going to start seeing people getting squeezed out of these properties and things because their interest rates are changing. The cost of money is getting more expensive, even on deals that they currently own, because their terms are up and it goes to an adjustable rate. I'm part of Grant Cardone's real estate club, and he was talking about that today in the meeting, that people are going to get squeezed. And then we had two different guys in the club that raise their hands. One of them had a couple properties, and then another one had one that their rates are adjustable now, and they're getting squeezed on those properties. We're going to continue seeing that, and the levels and the amounts of people that are getting into those positions are going to be getting bigger and bigger, and that's when the deals are going to come. So. We talk about, people talk about blood in the streets, and that's what they're talking about, is these people aren't going to be able to afford to keep their properties. So they're going to lose the guys that come in and have the networks and have the things in place to buy them are going to win. So, and when we're talking about, a recession, and we're talking about these things, and, kind of look at what happened 79 to 83. That was a rough 4 years, probably I was born in 1980. But that was a rough 4 years for a lot of real estate investors back then, I would say. Um, but if they were able to hold on and they held on to their properties and they weren't overextended and things when those things started hitting, I mean, imagine by 1990 where they were, by year 2000 where they were financially. So just because we're in a downswing right now and real estate might be a little scary or whatever, just keep in mind real estate's a long game. Vina Jetty on the Sunday call said it's not timing the market, it's time in the market. And so when you look at it like this and you say, oh, well, this was 4 years that things were really bad and people were hurt. Well, if you're able to hold on another 4 years, you're in pretty good shape again, I'd say. So just, time in the market, and not timing the market. So just keep that in mind as you guys are going about it. So Daniel, I see your hand up.
Hey,
Go
how
ahead,
you
buddy.
doing, guys?
How's it going?
Kevin invited me to come in here tonight, and I actually met him in one of Grant Cardone's spaces on Twitter, and just from putting myself out there, it turns out he lives only like 15 miles away from me.
Awesome.
And pretty cool there. So I just want to share, like, I'm learning so much in the past 2-3 weeks of participating in spaces and groups like this. But like about 8 months ago, I sort of, without knowing any of the stuff we're talking about, foresaw what we're going through now. Like I said, my wife and I own our house outright. So I talked to her and said, let's put this house on the market and try to sell it before the real downturn, So we're closing in 2 weeks. We bought the house 2 years ago. We bought it for 250 and we're selling it for 350. So, I mean, in my life, I've never had that kind of cash in the bank. My father-in-law bought us a house when we got married, which is like one up in the game.
Yeah.
So I said to myself, I see the rates going up. I don't think they're going to go down for a while. I think they're going to continue to go up. And I talked with several people who felt the same way and thought that we might not see the extent of this for like maybe even a year from now, right? How bad it might get. So we're renting a house. We're signing a lease this week, and we're gonna go from owning a home when many people in my family told me you're crazy. You already own a home outright. What are you doing? Just live there. You what are you doing? And I'm like,
Yeah.
I have a plan, and I really believe in this plan. And so I'm grateful to be here, guys. Thank you.
Nice. It's good to have you, man. All right. So, the possibilities, there's a few different options and things that are going to happen. It's going to go one of two ways. Number one, the inflation rate or the CPI may continue to go up, and it'll force the Fed to continue to raise rates. There's a lot of experts on this side that say that's what's going to happen. The Fed's just going to continue to kind of hard nose. Kind of what I think personally is going to happen. I think we're going to, I mean, I don't want to, say this like I've got a intuition on or anything, but just from me listening to people and reading articles and all that, I think we're going to see a rate hike at the beginning of February, possibly a quarter point, probably another one in March. A lot of people are saying we could see it again in May, but and then about the same amount of people are saying that they're going to stop in May. But kind of the benchmark of what the different ones in the Fed have been on TV saying is that they're going to get to where they're around the 5% range on the federal funds rate and before they start kind of calming down. But that's anybody's guess. I mean, who would have guessed COVID? Who would have guessed all these different things? I mean, we're one push of the button on one of these crazies running one of these countries that, it could blow everybody's predictions and everything out of the water. You just never know. So, but possibility number two, the inflation rate or the CPI starts coming down faster than they expect, and they start lowering rates. I've seen. I watched a guy the other day on Bloomberg that was saying that he thought by this time next year we'd be back down in the threes, maybe in the twos. But no one knows for sure what's going to happen. Or how long it's going to take to get there, no matter what happens. We don't know how long it's going to take. We don't know any of that. But the thing that I just want to kind of tell you as far as, from the financing end, I know a lot of people go, there's probably people on this call that have bought a property here recently and used an assumable mortgage. Or, and they're using an assumable mortgage and taking a property over at a 3% rate. That's good for cash flow. But you bought a property at a 3% rate, and hopefully that term on that loan has got enough time in it before you have to refi or anything like that, for the value to either come up, rents go up and the value to come up, or, for the rates to go back down. So I want to caution you, keep looking, keep, trying to buy things, but just be cautious. And, a lot of the sellers, we're looking at properties every day ourselves. And a lot of the sellers are still trying to sell properties with, and the idea is, well, you could do this, this, and this to the property, and then you'll have the value will be X, but they're charging you for half of the X, and I just want to caution you not to fall for those games and not to go into those games. And hey, if you want me to pay X, you do X before I pay for it, and just, I'd hold a hard line with the sellers. When you're running your numbers are the same numbers that every other investor is going to come up with on that property if you're running your numbers right. So if you're coming in and you're saying, oh, well, I can pay this, and maybe you're the only guy saying you can pay this, you might want to get a second opinion on your end and talk to somebody else in the group and say, hey, what am I missing here? So, I don't want to, we're in the mortgage business. We only make money when people buy and sell or refinance. So I don't want to talk people out of buying. And I don't think you should be talked out of buying, but I do think that it's a good idea to be more cautious, take a harder line with the sellers, because we are in a buyer's market right now. The changeover has happened. Sellers are no longer in control of these deals. Back 7-8 months ago, you couldn't put in an offer without putting, $20,000 or $100,000 up, as earnest money right off the bat. And now, I mean, you're getting 30 days, to look at the property and dissect it, after you sign that, letter of intent, before you have to put your earnest money down, or that's what I'm telling people to do anyway. So just, go into it, cautiously and be careful. Make sure you get longer extended terms on your debt. You don't want to run into a situation and buy something maybe with a bridge loan, if you get a bridge loan right now, where the debt's going to come due in a year or 2 years or 3 years, because we don't know what's going to happen in the next 3 years. But if you have it spread out to 5 or 7 years, chances are some of the mess that's happening right now is going to be kind of straightened out. So need it for a quote. I have a lot of people that call me all the time. Hey, I've got this property, and they want to tell me over the phone what it does and all about it, which is fine. But for me to really get a quote to you, this would be something else you can take a picture of. Right off the bat, I need T12 rent roll, an operating memorandum, and a summary of what you plan to do with the property. So what you plan purchase it for, what you plan to do, what do you think rents are going to go to and what time, you know, and just kind of a plan. If you plan to hold it for 5 years, 10 years, just in your mind, what you want to happen with this property, write it down and give that to me when you give me these other things. So, and break it down a little bit. The T12 is a trailing 12 of profit and loss. You know, so if there's some newer people on here, that's what it is. It's just a profit and loss statement of the business on the property. Rent roll is just a list of all the people that you know, are renting, has their name, you know, when they sign their lease, how long their lease is, what their payment is, that kind of thing. And the OM is just a sales pitch from the broker. That I don't have to have that, but it's nice to have it just to kind of be able to. It has the all the details on it that I'll need, address, you know, all those types of things. Now the SREO and the PFS, you know, if you're the guy or girl bringing it to me and you don't have those things, there's people in this group that have those things. So a schedule of real estate owned, to be able to qualify for a multifamily loan, if that loan is, you know, a $5 million loan, you need to have a $5 million net worth to qualify for that loan. And so a lot of people, you know, not many people have a $5 million net worth. So that's where the network comes in. If you have 2 or 3 other people you can put together, that can be combined net worth. If it's, you know, one other person, there's people in the room right now in this call that, you know, I know could sign for a $5 million loan. So they're in here. Put your information in the chat. I want to encourage everybody to network with each other, not just on this call, but all the calls that you're going to. There's a lot of different groups and things out there. You know, I recommend being involved in all the different calls through the week with the Freedom Chasers. I know it's a lot, but jump around and try to get, you know, if you can't make every one of them every week, you know, try to make Peter's call, you know, one week and make another one the next week, you know, but just try to be on as many of them as you can and meet as many people as you can, because if you want to buy deals like this, you've got to have the network. So, yeah, I've heard more than one person say, our pastor was saying it this time last year, he was saying, you know, your network, you know, is your net worth. He said, show me who you hang around with today, and I'll show you what your net worth will be like 5 years from now. And so, and then also a personal financial statement we need for if we're starting to do hard quotes. So a soft quote, if you call me, the first 4 items here, I need those items, and I can give you a soft quote and just kind of a basis or a guideline on what you need, or on what we can do for you as far as a loan on the property. The bottom 2, whenever you get a signed contract and we're going to sign a letter of intent with you as a lender, I need those items before we can sign that and lock in rates and things like that and get the process moving. So, and that doesn't have to come from you. Like I said, that can come from a sponsor or a KP, or, you know, a key partner, they call them. So, all right. So I hope everybody got a little bit out of that, and got a lot of questions now. We'll go ahead and open up for questions. Y'all go ahead and fire away. Go ahead, Kevin.
Yeah, if you guys can raise your hands, we'll go in order and
Yeah.
hopefully get everybody's question answered.
Hey, Jerry.
Hey.
So just kind of like big picture, is it fair to say that like the Fannie and Freddie loans are kind of like the conventional lending of the multifamily space? Is that?
You know, those give us the best rates and terms that we got.
Mhm.
You know, when you get up to you know, the really huge properties and you're looking at amounts like in excess of 60 to 80 million, you know, Fannie and Freddie are going to be competitive, but there's life insurance companies out there that lend on those
Mhm.
properties, and they might beat Fannie and Freddie by 0.5 point. And when you're
Wow.
looking at 0.5 point at those loan amounts, that's a big deal.
Yeah.
You know, so Fannie and Freddie, sometimes CMBS for certain asset class. If we get something that is not multifamily, like storage units, hotels, those types of things, if it's above the $5, $6, $7 million mark, I like to go CMBS. If it's
Mhm.
below, a lot of times with those types of assets, SBA might be the best option. But CMBS, as far as what we have available, there's other options like HUD and things. You get into the HUD products, we have those available. I don't recommend those for people that aren't set up to do those. And a HUD loan is going to take 8 months to a year to get closed to begin with. And then when you're dealing with HUD, when you start getting construction and things like that involved in a process, you've got prevailing wages, you've got all this compliance that you have to hit, from the government regulations involved. And we own a construction business as well, my wife and I do, and we've been on the other end of that, where our construction company is contracted and done the government type regulated work, where we have to report payroll and we have to do all those things. And it's a real pain in the neck on that end. And most of these bigger projects that do HUD, they'll actually hire compliance officers just for that project. And they'll have somebody that's, a salaried employee doing nothing but making sure that all the contractors are turning in the right paperwork and all that. So unless you're a guy that, or a girl or a business that has done, 10 or 15 or 20 deals, most of us aren't ready to deal with a HUD project. So
Yeah, definitely. So as we're learning this game, suppose we find a deal we like, we get an LOI in. What are the elements that we need to have in place before getting a debt quote? What are some of the few key things that they're going to want to see? Is it having a KP lined up, or relationship? So
you're going to have to have the sponsor ready. The sponsor needs to be there and be a part of it before we can sign the letter of intent with you. I can give you soft quotes all day long. And just so you guys know, when I send a soft quote to you, I'm generally going to be a half a point higher than what will come in at. I try to be, and that way you're underwriting very conservatively. And if we have something that happens in the market in those couple weeks or month or whatever it is that you're negotiating, we're generally okay. I had a situation here in the fall where I had freaked out a little bit. We've got 3 different lenders we go through. We're brokers. We got 3 different ones we go through to do the Fannie and Freddie loans. And I had one of them that come back and I had quoted, I forget the rate. I think I gave him a 6% rate on a soft quote. And he was like in the final running on this property, and I got it back from one of my lenders, and he said, we're going to be at 7% and X this and that. And I was like, oh no, and I freaked out a little bit, and I was able to go to one of my other guys and say, hey, this is where I'm at, what I'm doing. And he came in right at the 5.5 where I was expecting him to. So we, as brokers, we've got, more than just the one option. So, I like that, being a broker, that, and we're always working, trying to get more contacts and things there to where we can service people better. So
awesome. Thank you, Jerry.
Yeah. Yeah. Go ahead, Daniel.
So, I'm acting as like sort of a bird dog for my uncle and his partners, who told me they don't want any deals under 5 million. And I asked them what the limit was going up, and they said like there is no limit, which obviously there is, but they said like up to hundreds of millions of dollars if the deal, like everybody says, it all depends on the deal. It all depends on the deal. It all depends on the deal. So, are you guys finding like, cause I understand bigger is better. So like I brought in the past week, I found 1 or 2 deals in the 25 to $30 million range, over 100 units. But they only make sense, like the cap rate's like below 5%, with, like you were saying earlier, an extra 3 acres with already the permit to build an additional 56 units.
Yeah.
Right? They're trying to sell you something that they couldn't pay for.
Yeah.
But so I understand the concept of not trying to make an ugly deal look pretty. I guess my question is, and I'm trying to also understand how to create value for myself when presenting deals to people with that type of money, because they could just say thanks for the deal and like here's a minimal bird dog fee and see you later.
Yeah.
So I'm just wondering what your thoughts are and how I can bolster my position. I'm thinking of forming an LLC with like a guy like Kevin, and I have a guy in Austin, Texas, who I might bring in to sort of bolster my value,
Yeah.
so I don't get squeezed out of deals that I find, because I will find them. Thank you.
Do you trust them?
Yeah, so the people I've mentioned, yes, I trust.
Okay. Yeah. And so,
But
I
they're
mean,
still not gonna give me a percentage of the deal if I don't offer value,
yeah.
besides bring the deal to them.
Yeah. I mean, I would just make sure that you can add value to the deal, and work on, education to where you're bringing the deal to them and you've got all the I's dotted and the T's crossed. I mean, there's a lot of different ways you can do it, and you can, find out what their expectations are of you, and then tell them what your expectations are of them, and just go into it from the front and say, hey, I either want the finder's fee or I want half of the finder's fee and I want some of the equity, just or GP status or whatever you want on the deal, and you got to kind of decide what you want to get out of the deal, whether it's a long-term wealth gain or whether you want to just make that cash up front. I mean, a lot of times, on these bigger deals, you'll have a $60 million deal and there's an acquisition fee involved, that goes to the GP team as the deal closes. And that can be anywhere from 1 to 5%. So, when you got a $50 million deal, that's 500 to $250,000, that is there, or yeah, 2.5 million, 500,000 to 2.5 million dollars that's there available to pay out, either, to the GPs, to the guy finding the deal or whatever. And you could take that money that you're getting there and just put that back into the deal and say, hey, I want to be a lending partner on the deal, or whatever. There's a lot of different ways to do that. So
Yeah, because like only having, I mean, I say only, but to me, I'm talking with such big numbers that it makes my 300,000 that I thought was a lot seem like a little, which is fine. I'm trying to be a good steward of that 300, and it's
yeah,
almost feeling like it's going to take years to get to the point where I can put my own, $2 million towards a $20 million deal
yeah,
with someone else who's putting 2 million and another person with 1 million. And maybe, but I am a go-getter to the point that I am going to, in the next month or two, find a good deal, and it's going to be one of those 20 million and up deals, over 100 units. And I want to bolster my value. And I'm also a construction company owner, Jerry. So
okay,
I'm interested, like, in your thoughts on that, because that's really right now finding the deal and the construction company GC that I am is the two most value that I can provide, I guess.
yeah, yeah,
All right, thank you.
yeah, yeah. So, anybody else has any questions or anything, feel free to ask away. Robert Dodd, are you on here?
Yes, sir. Present and accounted for.
All right. I'm trying to find you on here. Oh, there you are. All right, great. Um, did you want to talk about the deal you'd sent me in public here, or?
Yeah, let's go through it. I think it'd be a good learning opportunity for me and for everyone else.
Yeah. Okay.
So just a quick little background. I'm also in Minneapolis, Minnesota, as I refer to it as.
Yeah.
But based on market data, I am direct broker in North Carolina, and my family has property in Orange County, California.
Okay.
So I am part of a real estate mentorship. As you mentioned, Jerry, you got to have those connections for multifamily. It takes multiple teams of investors, to
Oh,
take
yeah.
these properties. And the more people, the more high quality people like you and your family, the easier it is.
Oh,
And
yeah, for sure. For sure.
thank you for the fast turnaround on
Yeah.
that was outstanding service. So yeah, I definitely wanted to thank you for that. Yeah.
Yeah.
So this deal just came, from a broker out in Raleigh, one of my, favorite markets based on the data trends.
Yeah.
Population growth, median household income, favorable. It's a landlord friendly state. Let's just put it that way.
Yeah. Yeah.
The trick was the pricing guidance I received was a wish, from the seller. If I was the seller, I'd love to get that price
Yeah.
for the property. But, I'm still relatively new enough to look at the T12, see a negative NOI. And I understand that is related to the business model of, subsidized rents. But can you help connect those
Yeah.
dots for me a little bit, please?
Yeah, for sure. When I looked at it, you were right. It is negative on the cash flow.
Mhm.
But as far as the NOI, it is not negative. The NOI is before you pay your debt. Okay. And so just so everybody knows, this deal that Robert brought, it's got an NOI of like $464,000 according to the trailing 12. So, and it took a little math to figure it out because the T12 was like had 14 or 15 months on there. So I had to subtract some months and all that to figure it out. But it's got 464,000 in NOI. And you had said that they wanted to sell at a 5 cap. Is that correct? I think that's what you had said.
My buyers are interested at a 5 cap with the with the pricing guidance that I received. I mean, it's like a 2.8.
Yeah, a 2.8 cap. Yeah, that's right.
According to Marcus and Millichap, Charlotte's at a 4.5.
Oh, really?
From the report I received, it's changing obviously every month, but that's the numbers from that brokerage.
Yeah, and I showed you what we could lend in today's market at what I think it was a 6% interest rate or something like that, because it's in that lower tier of the Freddie and Fannie. It's in the smaller loan amounts, and I think I was at what 4.8 million or something that could be lent on the property according to today's market and rates and all that. Now this one does have an assumable loan, but something to be aware of when you're looking at these with the assumable loans, as far as what I'm seeing, their assumable loan is at 6.9 million. And really, if you're looking at that property, 464,900 is the NOI, and if you take that divided by 0.07 to give you a 7 cap, that's a $6.6 million purchase at a 7 cap.
Yeah.
And so that, lower than the amount that they have lent on the property. But if you go to a 6 cap, you're at 7.7 million. So, just that just goes to show how much the numbers have really changed just in a short period of time. And 6-7 months, the numbers have changed that much on this property, where when we were, it probably was a 4 cap, back 7 or 8 months ago. And so at a 4 cap, that property's worth almost 12 million bucks. But now, when interest rates are 6%, you don't want to pay a 6% cap. You want to pay a 6.5 or 7% cap, or you're almost upside down in the deal. So if your interest rate 6%, I would say always you want your cap rate to be higher than your interest rate.
Yeah, they were already negative.
Yeah, and so they're losing money every month on that deal.
Yeah,
so this is what
at 3.34.
Yeah.
Yeah.
Yeah. And so they're already upside down in this deal. And this isn't even somebody that has the one of these adjustable rates kicking in. They don't have that yet.
Oh.
And they're already upside down in the deal. Do you know how long their term is on this loan?
Oh, I think it was like, I want to say 2052.
Oh, okay. So
Yeah.
they've got, so they probably got a HUD loan is what I'm guessing.
Yes, exactly.
Okay.
Yep. Yeah. Precisely.
Okay. So yeah, I mean, it's great terms, it's all those things, but they're upside down and bleeding every month.
Yeah.
And bleeding every month. And they're telling him, when he calls them for guidance on the property, they're telling him they want 16 million bucks for the property. and he can only get $4 million in debt or $5 million in debt. So,
Yeah.
So just because the seller wants it, don't mean they're going to get it. So I would say this is a beautiful property and beautiful location, and everything about it is great, except the seller's mindset right now. He's just got to bleed a little bit before he throws in the towel. So.
Oh, can I do a quick follow-up question?
Yeah.
I don't see any hands up. I'm trying to connect the dots again on an interest only loan. Are there certain requirements that your lenders need to see? Is it, over 100 million? Is it a certain DSCR? How does that work?
It is a certain DSCR. We, with the Freddie and Fannie loans, we can do interest only periods, up to 5, 7. I think we can even get a 10-year option. The Freddie and Fannie loans are real kind of, I like to say they're fluid because they have a lot of different options. You can do them in a lot of different ways. If you request a certain way, they'll figure out a way to do it if they like the deal and want to lend on it. So yeah. Now, depending on the loan to value and all the different metrics, somewhere between 1.35 to 1.5 is where you need your DSCR to be. But just be aware when anybody on here that's underwriting and thinking I want interest only, the DSCR is still going to be figured on like you're paying P&I. So it's not going to be figured. You're gonna get a interest only payment, but the DSCR is going to be figured on P&I. So I hope that helps.
Just so that would be using just the real T12 as opposed to pro forma, right? For the P&I, or will they loan based on a projected gain?
I'm sorry.
The P&I, that's just based on the T12 as opposed to the pro forma numbers after.
Yeah, it will be based more or less on the last 3 months. So a T3.
Okay. When
you're looking at sorry, I'm getting pictures sent to me of basketball game score. So
okay, what's the
my
score?
son's at the ball game and my mom's at the game sending me pictures of the score. So it looks like they're we're down by 14 to the number 5 team in the state. So so to be expected, but never like to lose. So but anyway, but yeah, when the agencies are looking at the loans, it's always going to be based on a T3. They want to see a 90% occupancy or better, for three months or more. So everything's kind of based on that last three. They'll look at everything like from the last year, but that T3 is where they'll underwrite to the most. So
Perfect. Yeah, that helps me immensely. Thank you very much for that. The detailed explanation.
yeah, good. Good. So any other questions?
Yes, I have a question.
Yeah.
Good evening, everybody. My name is Gwendolyn. I'm here in Sacramento. I'm new to real estate investing as well as social media. I just happened to be lucky enough to find a deal that consists of 53 single families and 8 duplexes all in one pack.
Okay.
Would that fall under commercial?
That would be commercial. It would be it would be a DSCR type loan. It wouldn't qualify for agency debt. But it would be a portfolio loan that you would go after for something like that. And it would be a commercial loan. Generally for something like that, depending on the properties, depending on, all kinds of different things, you're going to be anywhere from 6.5% to 9% on rates on something like that. Where's the property located?
They're in Elyria, Cleveland, and Lorain, Ohio.
Okay. Yeah, you'll be closer to the 9, maybe 10% in that area. Now Cleveland, are these all lower priced homes individually?
On average, I'd say they're right about 100,000.
Oh, okay. Gotcha. On our portfolio loans, all the houses need to be 60,000 or over in value.
Yes, they are.
And they would all be appraised. But that's something we can definitely help you with.
Okay, because I'm new and I don't have a team. So
Okay.
I'm trying to find my way.
Gotcha.
And this just happened to land. And this is just the first. He's got 2 other packages that he's preparing to market.
Okay.
Okay. So I've got your contact information. I'll give you a call tomorrow.
Yeah, give me a call
Or
tomorrow.
whenever. Okay, great. Thank you so much.
Yeah, sounds good.
Hi,
Thanks.
Gwendolyn.
Hi there.
Are you there? Hi, join the multifamily Freedom Chasers group as well, and you'll be able to connect with a
I'm
lot
in.
of people. Yeah.
Yes, I just joined. Thank you.
Good. Awesome. Thank you.
All right, great.
And I became a Gator. And that's
sorry?
really something. Oh, no, I just said I just became a Gator. I just joined the Pace Morby Gator Club.
Oh, okay.
And I aspire to learn sub 2. That's what I thought I needed for something like this, was a sub 2 creative finance. But I'll give you a call. Thank you so much.
Yeah,
Awesome.
sounds good.
Questions,
All right,
anybody?
I'm willing to take a question about anything. How I got such a good looking wife or for any kind of thing.
Oh,
So
stop it.
Edward, how are you doing, bud?
Very, very good. Thank you so much. Hi, everybody. My name is Edward Tinde. I'm an investor in the greater Cincinnati area. I just have a quick question. So can we share like a deal that we have on a Freedom Chaser group on Facebook? Or do we have to reach to people individually?
You can always share a deal and put it out there. But as we're going through these calls, there's always people there to bring them to. But yeah, it's always you can always share them on the Facebook page. See if there's any partners or anybody that'd be willing to help out with deals and things like that, for sure.
Yeah. You can even put on there, I have a deal. Is anybody interested? And you can tell them where it's at, and you'll get feedback. Don't worry.
Oh, thank you so much.
Yeah. And
Glad you're here.
Edward, you can always just reach out to me too. So
Yeah. I'm lucky. Great. Thanks.
yeah, good to see you on here.
Yeah, great.
And really, is that how you pronounce your name? No. This is my oldest son, Riley, right here.
I know this guy.
So you were saying like you could just like post it in the group. How does that, aren't there laws against like asking for money on things from people you don't like know?
We're already part of the same network here.
Okay, so I didn't
But I
know
mean,
like being in the
Yeah, I
same.
mean, you're not presenting and making promises to people in the group. You're just saying, hey, I've got a deal here. Is anybody interested in looking at it with me?
Okay, yeah, I
Yeah.
just knew that there were like SEC laws and I just didn't know how those like applied there.
Yeah, Kevin is a real estate lawyer. I don't know if he'd be able to speak to that or not. Or I don't want to put him on the spot if he doesn't want to speak to it, but yeah, as far as that goes, I mean, we're all in the same club now. We're all in the same circle, and we're all rubbing shoulders with each other, several times a week on these calls.
All right, that makes sense.
Yeah, it's a good question. And Bryce.
Hello.
Hey, Bryce.
Hey, thanks for the presentation. How do you guys approach whenever it comes to fire damaged units on just a portion of the property? As far as the like 90% occupancy.
Yeah, that'd probably be if you're over 90% occupancy and you have a few fire damaged units, I don't know that we would be able to get them done through, I've not gotten anything like that done through the agencies.
Okay.
But as far as if there's over 90% occupancy, we might be able to shoot for it and try, but it would just be a deal where, showing funds to be able to, get them ready, that kind of thing.
Yeah.
But, usually those are just, they might be unfinanceable altogether unless you did a bridge or something,
Yeah.
So,
Yeah, that's what I was told previously was Bridge would probably have to take care of that. So just checking in on that.
But being that it's over 90% occupancy, it'd be worth talking to the agencies just to see, but like I
Yeah,
said,
because I think fire damage, like for this particular property, I think including the fire damaged vacancies, it was like 84% occupied.
okay. Gotcha.
Yeah.
So yeah, we would definitely need to do a bridge, just short-term bridge to give you time to get it ready, and then you need to have a T3 of 90% or more occupancy. So to be able to
Okay.
qualify.
So you would take that from the time that the damaged units were back online,
Yep.
and then a T3 going forward, and then judge off that.
Yep, a T3 showing more than 90% occupancy for 3 months straight, consecutive months. So
Okay. Yeah. Okay. I got you.
so, and I mean,
All
if it's quick work and things, you can get the work done quick. You could probably do like a 6-month bridge, have the work done and rent it in 3 months and have them back online. It just depends on how fast you work, and can get things done.
Okay.
And the bridge lenders, a lot of them, there's some out there that'll like want 12 months of interest, but there's others that'll, 6 months minimum. So if you do a 6-month, or a year long bridge and you have it ready in 6 months, and you can finance out of it in 8 months or whatever, and then you're only going to pay 8 months of the year you're going to pay interest. So
Okay. Yeah, that makes perfect sense. All right.
yeah. So
all right, thank you very much.
Yeah, no problem.
Okay, so
I see Edward's got his hand up still. Do you still have another question, or your hand just still up, Edward?
Sorry, I forgot to turn it down. I'm gonna do that now.
Yeah, that's all right, man.
We can start wrapping up. It's been almost an hour and a half now, but run to the next slide real quick.
Okay.
Everybody know, join the Freedom Chasers. The link is in the chat. In 2 weeks, we will be having another Zoom call. Like I said, we do this every other week. We can't do it every week. Hopefully in the future we will be doing, but what would you guys like hearing us talk about in future Zoom calls? Is there any, put it in the chat if you have it, if you know what you want to hear about. We try to cover everything, but
On the
you
next
know,
one,
more of
we,
this. Um,
yeah,
sorry, go ahead.
I was just gonna say on the next one, we're planning to talk about the different types of loans used to finance multifamily deals. So there's, you know, probably 8 to 10 different types of loans out there, and we'll talk about each one, kind of the benefits, you know, the good parts and the bad parts about each one. So
Also, I want to say, does everybody know Grant Cardone on here? If you know Grant Cardone, let me know. 10X it or something. Yeah, all right. Well, I've got to plug JJ in here because he's not here and he's really bummed that he's missing this Zoom call. He's done a YouTube video on Grant Cardone. I just put it in the chat. You guys can go in there and look at it. It's a really good video. He's gotten some, I'm gonna share his win. He's gotten some work out of it. People loved his video so much that they're contracting him to do videos like that of themselves and post it on YouTube. He's making that money now. And go and look at his video and like it and comment and subscribe. I think that's what he would say. I don't know. Thank you guys. Anything else? Here's our number, our contact information again. I'm not sure why that looks like that. I guess I didn't update it. Take a quick screenshot.
and is Peter on here still? Peter St. Martin?
Yeah.
Sorry, Jerry, are you talking to me?
I am. Do you want to talk about your Tuesday calls or Monday calls? Sorry.
Yeah, so absolutely, I appreciate that. I actually had another Zoom, so
Oh, okay.
thought I heard my name in the background. I'm glad I volume up a little bit, but
Yeah.
I posted in the chat. I put a link to the Freedom Chaser. If you're not connected to that, do that. That'll show you all the information that are available throughout the week. And there's another one coming up. So right now, like we said at the beginning, Monday night, we have the Family Freedom Chaser Activator Zoom. On Monday, that's Sunday night at 8:30. On Monday, and these are all Eastern Standard Time. On Monday at 2 p.m. Eastern Standard Time, we're actually taking action after we get activated Sunday night. We are making live phone calls to brokers. It's hard because you're literally, calling these people live, and many of them. But this past week, we had a couple of calls that sometimes we don't get any. I try to set appointments throughout the week to have a couple slotted, but even when you have an appointment, you don't necessarily reach anybody. But bottom line is, we started that Zoom because we saw that people were having massive resistance to picking up the phone and calling people. And the whole point of this Zoom is just to encourage you guys. And I think even if you're not ready to make a phone call, just show up, listen to calls happening, learn the lingo, hear what we say. We'll share scripts with you that you can use. We don't like to use scripts. We don't want to use scripts at all. In mind, right? And when you listen to me talk to these brokers, you can tell I'm never using a script. It's all off the cuff, but it's based on the knowledge that I've learned from studying those scripts. So anyway, just come join us on Mondays at 2 o'clock, Tuesday night at 8 o'clock, I think it is. We've got the napkin underwriting Zoom. Then every other Wednesday, we've got this Zoom here with Jerry and Shelly. So get those on your calendar. I know you're not going to be able to make them all the time, but show up as often as you can, educate yourself. I forget the gentleman's name who's talking about being a bird dog. It's all about education, right? Being a bird dog, you can get paid, and you can get paid reasonably well, right? But you're going to get paid based on the value that you bring to the deal, right? If you just hand a phone number to somebody and an address, a fee, but it's not going to be that much. If you actually learn to underwrite that deal and bring a fully underwritten package to potential investors, you're going to get paid a lot more.
When you learn to underwrite them, then the next step is learn how to raise capital for them. And if you can bring maybe a little bit of your own capital, maybe a little bit of your, capital from your friends that you've gotten to know. And like Jerry has said a couple of times, there's capital in this room. You just have to get to know these people. When they know, like, trust you, they're going to want to look at the deals that you bring to the table when they can see that you've taken the effort to learn how to identify a good deal. So keep coming back, keep educating yourself. Appreciate what you're doing, Jerry. Thanks for calling me out. And I look forward to seeing a lot of you folks. In fact, I know some of you have been there on Monday, and I appreciate you coming. Invite your friends and come on back.
Yeah. Awesome.
Thanks, Peter.
Thanks, Peter.
Thank
I'm gonna
you.
play some music here, some Grant Cardone music. You guys might know this.
So y'all have a good night.
Will you stop sharing, Jerry?
Yep.
When I walk through the door, looking cash flow. And if you know, like I know, you getting cash flow.
Hear my music? Thank you guys for coming out. It's been awesome.
And I wish you would try to test me, yo. You should listen to the lesson, though. Masterminds out of Mexico. I invested, though, and I let it grow. Regiments I got a pocket for. Raise your income and your taxes low. Spend it right and then the best more. And if you don't believe me, ask my doctor, though. What you mean? You mean Uncle G? Planting seeds for these money trees. Who got my money, please? Everywhere you wanna be like Visa, MasterCard, American Express. I bought the bank and I bought the jet. I buy apartments, I send checks. Yo, billionaire went undercover, help y'all discover who did it best. Just bought 2 choppers, can't wait till they see the face and they see what I do next. When I walk through the door, I'm talking cash flow. And if you know, like I know, you getting cash flow. When I walk through the door, I'm talking cash flow. And if you know, like I know, you getting cash flow.
Yeah, and only then do I buy something stupid. How stupid can you go? You can go as stupid as your cash flow.
You know what heals all ills? Deals. Look who went from me